All right. Welcome to another macro discussion. Today is Sunday, April 24th, and in this video, we're going to talk about transportation and the recent crash in transportation stocks. What does that mean for the stock market, and most importantly, for the broader economy? Because when you think about transportation companies, you think about inflation-proof kind of companies. Yes, fuel prices could be rising higher, wage costs could be moving higher, but these companies have the pricing power to say to whatever company they're transporting products from, be it coal, be it energy, be it cars, be it grains, hey, we're going to charge you whatever rate it is, whatever rate keeps the company profitable. So when the stocks of these companies crash all of a sudden, in a massive way, in a short amount of time, double digits or so, something is really alarming going on here. The stock market is sending a message about the health of the economy, and this is exactly what we're going to explore in this video. And without further ado, here it is, in focus tonight. It is falling apart. We're talking about the economy, and the crash in transportation stocks is a telltale for what's about to come. We start with some macro data here that we got throughout the week, specifically when it comes to the Fed. We talked about the Fed in the previous video, but Jerome Powell is ramping up the hawkish talk. The problem is he has one foot in and the other still out. He's being wishy-washy in his hawkish rhetoric. He wants to increase interest rates higher, but he wouldn't say for sure if he is in favor of a 50 basis points hike in the next meeting in May, for example, or not. This lack of clarity by the Fed is causing chaos in the market, and it's also causing inflation expectations to skyrocket. And this is a massive, massive problem for Jerome Powell and the Fed, because part of the game is actually tightening the monetary policy. But the other part is the psychology game, which is tackling inflation expectations. And it appears that the Fed is failing for now. Inflation expectations are sky high, and they continue to move higher and higher and higher with no stop in sight. And this is a clear indicator of the Fed's failure and desperation. It's not just in the US, by the way. This is a global phenomenon. Central banks across the globe have to tighten aggressively because they've been conducting a loose monetary policy for years. They've been printing money recklessly with no regard whatsoever to the consequences. And now they have to tighten aggressively. They think that they can engineer a soft landing, but for now it appears that the soft landing is just a mere fantasy. In New Zealand, for example, inflation is at 30-year high, which means that the Central Bank of New Zealand has to tighten even more. We talked about the Central Bank of Canada, for example, having to tighten even more and being even more hawkish than before. Here is the National Bank of Canada CEO warning that higher rates and inflation may totally wipe out the extra savings that consumers built up during the pandemic by 2023. Everything will be poof, gone. He says 2023, I say by the end of this year. What's going to happen when the consumer doesn't have the reserves to spend anymore? What's going to stimulate this economy? If the Fed is tightening, central banks across the globe are tightening, and the consumer is running out of cash. Not just in Canada, by the way, in the US, in the UK, in Germany. This is a recipe for an upcoming global recession, the likes that we have never seen before since 2009. The difference between now and then is back then the Fed and other central banks had plenty of ammo to reignite the global economy. We also had China back then. China was doing better than a lot of countries, so the road for recovery was a lot easier. This time around, central banks will be out of ammo, and the Chinese economy is struggling big time. Perhaps the most alarming part of this inflation is food inflation, because food inflation is becoming the primary driver for this inflation. And we know that the consequences, for example, for gasoline prices moving higher is a lot of folks not going to drive. But there is an alternative, for example, working at home for many workers. But when it comes to food inflation, there is no alternative. If food prices continue to move higher with no stop in sight, we will see starvation, hunger, which will lead to uprisings and political chaos. And of course, your beloved media is never going to be honest with you. For example, look at this, the Washington Post, the government newspaper. In this piece, they say 4 hidden reasons food prices are crazy right now. And I've been reading the article, and I'm waiting to get to the part where they say the Fed's reckless policy of printing was behind the increase of food prices, because this is the number one reason behind this inflation, the insane money printing. stimulating excess demand in the economy. And the supply chain, COVID or no COVID, would never be able to cope with this kind of insane demand. But of course, in this piece, they never got to the Fed. It's Russia, it's Ukraine, it's the shortages here, the shortages there, it's China, but no mention of the Fed whatsoever. Why? This is done by design to keep the American public dumbified about the root of all evil, the Federal Reserve. And the most alarming part is what happens when you have an economy where inflation continues to move higher while the pace of economic activity is slowing down. We have a phenomenon called stagflation. And stagflation is one of the most destructive economic phenomenons that any economy can go through. Well, let's hear the data. Every single day, we get more proof that this economy right now is indeed in stagflation. For example, we got the flash PMI on Friday, and here's the headline from Bloomberg. It reads, a measure of prices received by U.S. manufacturers and service providers increased to a record in April as firms shifted the burden of higher wages and surging costs to customers. Yep, you and I, baby. So prices continue to move higher, and these firms are passing these extra costs down to you and I, the consumer. And they will continue to do that because there is no alternative. The other alternative is to lose money, to crush your margins as a company. They're never going to do that until and unless the demand is already crushed in the economy. So, okay, inflation continues to move higher. What about the pace of economic activity? Here it is. The S&P Global U.S. Composite PMI shows that this economy is slipping down. Look at that. The chart is moving down. It is stagnating, and it is curling its way down, not moving higher. When we talk about the services PMI, for example, the core of any healthy economy is the services sector, not the manufacturing, not the goods sector. If you have a healthy inflation in the economy, it should be led by the services sector of the economy, not the goods or manufacturing. Look at services, it is moving down. Here is the commentary from Chris Williamson, the chief business economist at the S&P Global. He said, although still indicative of annualized GDP growth of approximately 3%, the April PMI surveys point to the upturn losing some momentum compared to the strong rebound seen in March, when services activity in particular had been buoyed by loosened pandemic restrictions in the U.S. and abroad. Many businesses continue to report tailwind of pent-up demand from the pandemic, but companies are also facing mounting challenges from rising inflation and the cost of living squeeze, as well as persistent supply chain delays and labor constraints. These headwinds, plus increased concerns over the economic outlook and tightening monetary policy, meant business confidence about the outlook slipped sharply lower in April. However, with the overall pace of economic growth and hiring remaining relatively solid for now, the focus from a policy perspective is likely to remain firmly on the need to rein in the record high inflationary pressures signaled by the survey. And they continue to say, oh, the job market remains tight and hot, and therefore the economy is okay. Folks, did we forget what happened back in 2009? The job market was great in 2007 all the way to 2008. Maybe the fourth quarter in 2008 we started to see some problems, but in 2009 there was a rapid loss of jobs. It was instant, mind-blowing. We were losing thousands and millions of jobs. So all of this talk about, oh, the job market is tight and therefore the economy is doing all right, that's garbage. It's bullshit. Because the majority of these jobs we've been creating in the last few months are leisure and hospitality jobs. When the Fed tightens the monetary policy, aggressively so, and they have to do so because inflation is sky high, the demand in the economy will get crushed fast. And we talked about the changes in consumer behavior in this channel numerous times. For example, the survey that I shared with you in the previous video. What happens if inflation persists? What happens if prices continue to move higher? What happens if the Fed increases interest rates dramatically? The consumers say they will cut down spending on dining out, for example. That's number one. But most importantly, the consumer says they will cut down vacation plans. So when the Fed starts tightening, we will see losses in these leisure and hospitality jobs rapidly. Don't be fooled by the so-called hot jobs market. It's not even hot. It is a zombified jobs market fueled by the Fed's cocaine. When the Fed removes that cocaine accommodation, the reality of this economy will appear, and it will look ugly, ugly, ugly. And of course, the Fed is sending these zombies. For example, on Friday, they sent Cleveland Fed President Loretta Mister, who said, oh, don't worry about the 75 basis point hikes. Jim Bullard was just too high when he said that. We're not going to do any of that. And I say, Loretta, mister, it's not up to you. Inflation is in the driver's seat right now. Inflation will force your hand to do a 50 basis point, 75 basis point, a full point hike. Remember last year they were saying, oh, 50 basis points will never happen. Now we're talking about 50 basis points in the bag. And here it is. Look at this. They say the Fed projected path. You see that dotted orange, red line, whatever that is? It will move to 2.5%, the Fed's target for now. Then it will plateau and move down from that point on by 2025, for example. Then we have the market implied path. The market says, forget about it. The Fed will be forced to go over the 2.5% target that they're talking about. We will go all the way to 3% and then plateau from that point on. And I say, here it is. Let me fix this for you. Yep, more like 5%, and then we plateau from there. And this is, by the way, the upbeat outlook from me. You really think 2.5% will do the job in this insane inflation that we haven't seen since the 1970s? Matter of fact, even Larry Summers admitted that. He said if we use the same formulas of the CPI from the 1970s today...
You know, David, I saw something recently that brought this home to me. People think of us as having had 13, 14% inflation in the 1970s. But that's only because of the way it was calculated then. If you use the same way we calculate inflation now, it got just above 10% in the 1970s. So getting to 8.5, we're actually closer to being back there than I think most people realize.
So this is the worst inflation crisis in this country's history. And the Fed says 2.5% will do the job. Give me a break. And the market expectations are moving higher and higher and higher, by the way. The Fed will have to be even more aggressive than the 3% that the market is implying right now, because real yields are now positive once again. We haven't seen real yields this positive since before the thing started. What does that mean? It means Tina, there is no alternative. Well, Tina is dead for good, and she's not going to come back for a long, long time. So all of you have been saying, oh, you got to buy stocks regardless of the valuations because at Tina, there is no alternative. What are you going to do? Buy bonds when the Fed is buying? Well, now Tina is dead. So what is your excuse to support these insane valuations in the stock market right now? Nothing. Zero. Earnings, you said? Is that what you said? Earnings? Be careful what you wish for. And there is another indicator that shows more trouble in this economy. It's called the fluffy puppy indicator. And the fluffy puppy indicator is flashing red. What does that mean? Over the 4 weeks that ended April 9, sales of pet supplies, in other words, non-food items that pets don't need to live, fell 1.9% according to the latest data from Nielsen. That is a sharp drop from the 12-week average increase of 3.6%. Pet grooming, for example, plunged 19.2%, while dog accessories fell 12.1%, and pet bed sales declined 12.7%. The lone increase of any size came in cat litter, which saw an 11.7% gain. You don't want to mess with your cat. If the cat wants a new litter box, you're gonna get a new litter box. Otherwise, she's gonna curse your stock portfolio. You're gonna start to lose money. Think about it. But this is a telltale. When the thing started and people were locked up at home, they adopted a lot of pets. They thought it was cute and cool. I'm alone. I gotta have a dog, a cat. And the problem these days is the economy is souring, inflation is sky high, so they're cutting spending on their pets. They're not grooming them anymore, and perhaps the most tragic outcome of all of that is when the pet needs medical treatment, you got to think about it now. Can I afford to take the dog or the cat to the vet? And therefore, unfortunately, we're seeing a lot of pet owners, these dummies who adopted pets because they thought it was cool. It is a lifetime commitment. But anyhow, they're now abandoning their pets. And they're ashamed to go to the shelter and say, hey, I cannot take care of this dog or this cat anymore. They leave the cats and the dogs in boxes and crates right at the door of the shelter and leave. And now we have shelters across the country, at least here where I live. They're packed with dogs and cats, abandoned. The owner cannot take care of the pet anymore. And at some point, when these shelters get really packed, they have to get rid of these animals. They got to put them down. It is absolutely tragic and irresponsible. But once again, we can blame the Fed for all of that. When you see all of these pets abandoned, say thank you to the delusional madman, Jerome Powell, and the Federal Reserve. But you know what's even more important as an indicator than the fluffy puppy indicator? It is the transportation indicator, because it's a reliable indicator. it has been in for over 100 years now. It is the transportation indicator. And the headline reads, Gloom in Transports Sent Smoke Signal for U.S. Stocks. What are they talking about here? It is another nail in the market's possible coffin, said Sam Stovall, Chief Investment Strategist at CFRA. Listen to this. If transports are underperforming, investors are inferring that consumer orders will likely be slowing as well due to ongoing supply disruptions, rising inflation, and inverting yield curves. On Friday, Stephens analyst Jack Atkins said he saw risks to fried demand later this year and into 2023, as Fed rate hikes remove liquidity from the economy and spending on goods likely returns to historical levels, with the thing restrictions easing. The weakness in transports fits right in with the broader mood in cyclical stocks lately, with groups such as banks, home builders, recreation vehicles, and semiconductors either in or threatening relative downtrends. This is not a particularly risk-on message, and we maintain a cautious view broadly. BTIG's chief market technician Jonathan Krinsky wrote in a note, the recent sell-off in transports has been led by truckers, parcel delivery companies, and railroad operators, with airlines remaining relatively unscathed. For now, they have this false optimism that airlines will be able to continue to have their inflationary power of passing the extra cost to the end consumer. Wait till the Fed starts tightening aggressively. The demand for airlines and flying will drop like a rock, and these airline companies, some of them, will even face bankruptcy, and therefore you're already seeing the M&A activity already heating up. Spirit Airlines, for example, that will go bankrupt, and therefore they're already talking about M&A with JetBlue and Frontier. So regardless of what you hear on TV and in the media of all of these airline executives coming out and saying, oh, we're seeing the hottest demand in history, this is the best quarter in history, the numbers and their M&A strategies suggest otherwise. Be careful here. JB Hunt Transport Services, Matson, Old Dominion Frightline, Ryder Systems, and Landstar System have dropped the most. And it's not just the US, by the way. In Europe, logistic giant Maersk plunged on Monday amid worries that a fresh round of Russian trade sanctions, along with a weaker global economy, might lead to a dip in demand for goods around the world. Shares of peers DSV, Kuhn, Nagel, and Hapag-Lloyd also took a beating. So what does that mean, all in all, for the economy, but most importantly for the market? Here it is. The weakness in transports, along with deteriorating relative price trends of other important economically sensitive areas, such as financials, home builders, and semiconductors, alongside the yield curve inversion, suggests risks are rising, said Keith Lerner, chief market strategist for Tourist. And here comes the but still, some see a possibility that the rout in transport stocks will be restricted to the sector and only reflects a shift from spending on goods to travel, expenses, and services, given the reopening of the economy is finally gathering pace. They've been jerking off to the so-called reopening of the economy since last year. We've been waiting and waiting and waiting for the so-called reopening to happen, and it never did, because inflation continues to move higher. We have more lockdowns globally, in China specifically. So where is the reopening? It's never going to happen, because even if it happens right now, inflation is already changing consumer behavior. And they're talking about services, the comeback of services. Have you seen the PMI for services? That's actually moving down. Anyways, here's Arthur Hogan, the chief market strategist at National Securities, and he has to pump, of course, otherwise he doesn't get paid. But here it is. I do not believe that the transports are telling us that we're going through a significant economic slowdown, but rather that consumption patterns are shifting back to what have been the historical norms of the last quarter of a century. Well, good luck with that, Mr. Hogan. Here's the DJT, the Dow Transport Index. This is a monthly chart, by the way. This is a chart begging to be shorted. Look at that shooting star candle, for example, and this is the technical outlook. Any technician looking at this, would look at the shooting star candle and say, we got trouble here. On top of that, we have a MACD indicator that is crossing to negative territory, showing a red impression in the histogram, indicating the best is behind us. Likewise, we have negative divergence on the RSI indicator, and this is a telltale that this chart is weakening significantly. If we use my support lines, the chart could go down all the way, by about 23%. And that would be support number one, by the way. It could go further down. But this is, if we use the Fibonacci levels, the chart could go down, about 20%. But this is support number one. It could go down further. Now, when you look at individual transport stocks, the picture gets gloomier. And either this is the greatest overreaction in the history of the stock market, or It is a dire indicator, an ominous indicator for something really, really bad about to come. Look at UNP, for example, Union Pacific, the largest railroad company in this country. The stock went down by over 16% in less than a month. And here's another one, the ticker JBHT, JB Hunt. This is a trucking company. The stock went down by over 24% in a matter of a month. This is absolutely alarming. What's going on here? Breaking a trend that goes back all the way to 2020. Another one, the ticker MATX, Matson. This is a shipping company. The stock is down over 30% in about a month. What's going on with the transports? And by the way, it's not just the transports. This week, we saw the crash of commodity stocks, from aluminum to copper to steel to even the fertilizer stocks. I mean, if these go down, if the transports and the commodity stocks go down, then there is nothing left here. We're heading for the crash. But rest assured, somebody here says transportation stocks have fallen enough. Even if there is a fright recession. Yeah, even if there is a crash, even if there is, a depression, please don't sell. Otherwise, we lose money. But look at this. These are the container rates. Shanghai to LA in blue and Shanghai to Rotterdam in red. Freight rates are falling down. Now, you could say, well, this is good. It means inflation is peaking. Are the freight rates going down for the good or the bad reasons? The good reasons would be increased supply. We have more containers being built and the supply chain is ramping up and catching up with the demand. The bad reasons would be either number one, demand is being crushed in the economy already. Number two, the lockdowns in Shanghai, because that means that the moment they reopen again, we will see rates moving back up. For example, look at one of the busiest ports in this country, Long Beach. Container imports, yeah, they're plateauing, maybe they're curling a little down, but there is no slowdown in demand here. If there is any slowdown in demand, it would be because they cannot get containers. China is locked up. So again, when you look at this and you're the Federal Reserve, Jerome Powell, for example, you have a long way to go to start crushing the demand in this economy, to tackle this inflation, meaning you have to be even more aggressive in tightening the monetary policy. I don't see any demand destruction right now. I see demand destruction after the Fed becomes really aggressive. There's a lot of talk of demand destruction. What are you talking about? What are you smoking? Look at jet fuel stockpiles in the East Coast, for example. These are the lowest levels since 1996, which means we have a shortage of supply and we have an out-of-whack demand. Another proof that the demand is out of control and it's going to be crushed when the Fed becomes really aggressive. Here it is. United and American Airlines replacing planes with buses on some routes in an attempt to tackle the pilot shortage. Oh, you booked a first-class ticket? Sorry, it's in a bus. But hey, the good news is we got peanuts. And when we talk about this economy being too hot, yes, there is such a thing. When it's too hot, it's bad. Specifically when it's fake hot. Like the Fed, for example, propping up the economy via cocaine, via endless printing. That's fake demand. That's a fake hot economy. Yes, there is such a thing where it's too hot, it's bad. Like Amber Heard, for example. You hook up with this girl. You date her. But you never marry a girl like that unless you're looking for trouble. Like, waking up in your bed, finding shit all over the place. You think Johnny Depp didn't know about that when he got into this deal? But I guess,
The heart wants what the heart wants, I guess.
Heart also wants what the dick wants.
anyways, here's the problem, and we go back to the premise of this video. Transportation companies, specifically railroads, for example, are supposed to be winners of this inflation. Yes, there are winners, there are losers within transports. For example, trucking, they have to pay the extra fuel cost. The question is, can they pass that extra cost to the end consumer? Well, they've been doing that, I would say, successfully for the last 2 years or so. When we talk about railroads, they have even a bigger advantage in passing that extra inflation cost. Not anymore, though. Diesel prices are moving higher. Look at this headline from the Wall Street Journal, for example. It says, surging oil prices usually produce both winners and losers for transportation companies, but not this time. Something has changed here. Is it that these transportation companies are not able to pass that extra inflation cost to the end consumer anymore? Well, we're not seeing that when we look at corporate earnings. For example, last week we got CSX, we got Union Pacific. We're not seeing demand destruction in the economy, specifically in transportation. But remember what they say. The market always looks forward. The market is usually a mechanism where investors bid on where the economy is going to be 6 months to a year from now. And when investors dump transportation stocks, are they saying that 6 months to a year from now, after the Fed starts tightening the monetary policy aggressively, we will see the demand being crushed in the economy? And one of the biggest casualties will be transportation stocks, transportation companies, and hence, this is the time to book profits from these kind of companies. What does that say for commodity stocks, by the way? Because this week we saw a massive sell-off in commodities. Not oil, but materials. Are investors seeing that 6 months to a year from now, we will see massive demand destruction? And this is the time to book profits? It's an intriguing thought. Let me know what you think in the comments. But for now, this is all I got for you. The technical analysis will be out this evening, so stick around. But for now, I gotta say thank you for listening. Thank you for watching. I will talk to you again soon.